Hello students, welcome to JK classes. This is Professor C.A. Dhaval Thakkar. In this particular video, we are going to discuss RTP of paper 1, that is nothing but accounting, specifically in that only accounting standards for May 23 examination. So this video is for RTP of accounting standard paper 1. Let us start the questions one by one. First question is based on framework for preparation and presentation of financial statement. A Limited has entered into binding agreement with Gamma Limited to buy a custom made machine for ₹1 lakh. At the end of 2011-12, before delivery of the machine, A Limited had to change its method of production. Now you might be thinking, then sir, A Limited will not purchase the machine from Gamma Limited. A Limited will cancel the order. Boss, here A Limited cannot cancel the order because if you can see here, A Limited entered into binding agreement. It means, sir, there is a present obligation arising out of the past event and it is certain that there will be outflow of economic benefits to settle such obligation and where the amount can be measured reliably. So we have to provide for the liability in our books of accounts. So boss, we have to create liability, that is nothing but the liability for payment for machinery. Okay. Now, sir, we are purchasing machinery. The new method will not require the machine ordered and it will be scrapped after delivery. Because once we get that machine, we have to scrap it. Then, sir, can we recognize this machine in our books of accounts? The answer is no. As per AS10, property, plant and equipment, tangible fixed asset recognition criteria, which says if it is probable that future economic benefits associated with asset will flow to the entity, then only we can recognize the asset in our books of accounts. So boss, we cannot recognize this machine in our books of accounts. We have to write off. We have to write off this in P&L. So basically, sir, this is nothing but the loss for us. So P&L account debit to liability for payment for machine. Ideally, if I can say, sir, the genuine entry should be machine account debit to liability for machinery because we have purchased the machinery and we have to pay for it. But here, sir, liability is there because in any case, even if we are not going to use this machinery, we will have to pay for this machine. Then, sir, liability will be created in any case. And along with that, sir, asset we cannot recognize in our books of accounts. We have to debit P&L because we will not recognize it machinery in our books of accounts because recognition criteria of AS10 is not fulfilled. So this machinery is of no use for us. We cannot say that machine is asset for us because we are not going to get any future economic benefit. Then we have to debit P&L. We have to write off this machinery. And again, that there is no scrap value also they are saying. The expected scrap value is nil. So entire amount of machinery is lost for us. We are not going to get any benefit. So we will debit our P&L. So let us see the answer because they are asking you are required to advise the accounting treatment and give the necessary journal entry in the year 2011-12. So this is your solution. A liability is recognized when outflow of economic resources in settlement of a present obligation can be anticipated and the value of the outflow can be reliably measured. In the given case, A Limited should recognize a liability of 1 lakh to Gamma Limited. So here in the first paragraph, they are talking about liability. We have to recognize the liability because there is a present obligation arising out of past event and it is certain that there will be outflow of economic benefits to settle such obligation and the amount can be measured reliably. Now in the second paragraph, they are talking about recognition of asset, whether we should recognize or not. Let's read. When flow of economic benefits to the enterprise beyond the current accounting period is considered improbable, the expenditure incurred is recognized as an expense. It means they are saying we will not get the future economic benefit. So in that particular case, we have to recognize this as an expense and not as an asset. In the present case, flow of future economic benefits from the machine to the enterprise is improbable. The entire amount of purchase price of the machine should be recognized as an expense. They have passed the entry loss on change in production method to Gamma Limited and then profit and loss to loss on change in production method. So basically the net entry, if you want to pass, then P&L account debit to Gamma Limited. Basically this Gamma Limited will become liability for us. This Gamma Limited will become liability for us. Okay, let us move to the next question. AS1, disclosure of accounting policies. In the books of Rani Limited, Closing inventory as on 31st March 2022 amounts to 1,75,000 based on FIFO method. Okay. The company decides to change from FIFO method to weighted average method for ascertaining the cost of inventory from the year 2021-22. On the basis of weighted average method, closing inventory as on 31st March 2022 amounts to 1,59,000. So sir, earlier they were using FIFO method. If they would have continued this method, then inventory would be 1,75,000, but they are shifting from FIFO to weighted average method, and the valuation based on weighted average method is 1,59,000. So definitely this is nothing but change in accounting policy. Similar question is there in JKC textbook. So sir, this change in accounting policy we have to disclose in our books of accounts. Realizable value, that is nothing but the NRV of the inventory as on 31st March 2022 is 2,07,000, which is more than the cost. Even though you are going for FIFO method or weighted average method, sir, NRV is more than cost, or I can say any of the cost. In that case, definitely inventory will be valued at lower of cost to NRV, that is at cost only as per AS2. Discuss disclosure requirements of change in accounting policy as per AS1. So majorly we have to focus on AS1. They are asking discuss, or I can say disclose the disclosure requirement. Disclosure requirement. Okay, so sir, as per AS1, if there is a change in accounting policy, then any material effect because of change in accounting policy we need to disclose. After that, sir, the item of general purpose financial statement affected because of change in accounting policy, that also we need to disclose, and the amount by which that particular item is affected, that also we need to disclose. If in any case we are unable to ascertain the amount of change because of change in accounting policy, wholly or partly, the fact also should be indicated. Let us see the solution. As per AS1, disclosure of accounting policy, any change in accounting policy which has a material effect should be disclosed in the financial statement. The amount by which any item in the financial statement, that is nothing but the general purpose financial statement only, is affected by such change should also be disclosed to the extent ascertainable. Where such amount is not ascertainable, wholly or in part, fact should be indicated. Now this is nothing but first para ideally, that is nothing but the provision of that particular standard which we have to mention or which is related to this question. Thus, Rani Limited should disclose the change in valuation method of inventory and its effect on the financial statement, and how they are supposed to disclose they have mentioned, because definitely there is a change in accounting policy. Earlier we were using FIFO method, now we shifted to weighted average method. So definitely 1,75,000 minus 1,59,000, there is a difference of 16,000. So the effect will come as well as on closing stock and on profit. The company values its inventory at lower of cost and net realizable value, since the NRV of all the items of inventory in the current year was greater than respective cost. The company valued its inventory at cost. In the present year, that is 21-22, company has changed to weighted average method, which better reflects the consumption pattern of the inventory. What they are trying to say here? Here they are trying to say that this change in accounting policy is done by management. Because if you remember, change in accounting policy can be done if it is required by law or AS or management. But in case of management, management has to justify that this change will result into better presentation, preparation of financial statement. So they are saying that after changing this accounting policy, it is resulting into better consumption pattern of the inventory. Okay, for ascertaining the inventory cost from the earlier practice of using FIFO for the purpose, the change in policy has reduced current profit and the value of inventory by 16,000. Let us move to the next question. AS2, valuation of inventory. An enterprise ordered 20,000 kg of certain material at rupees 110 per unit. Purchase price includes GST of 12 per kg, in respect of which full input tax credit ITC is admissible. Because if full credit is available, then this will not become the cost of your inventory, because this is nothing but the refundable tax, or I can say adjustable tax, against which the set off is available, I can say ITC is available. So this will not to be considered as cost of your inventory. If you remember, in AS2, while calculating cost, we have seen the components of cost of inventory. In that, one of the component is nothing but the purchase cost, which says purchase cost includes purchase price minus trade discount, or I can say quantity rebate, plus non-refundable taxes, plus loading charges, unloading charges, transportation expense, transit insurance, toll charges, or any directly attributable expense incurred to bring that particular inventory to the godown. Okay, so that we have seen in CA foundation also. That is nothing but in consignment chapter we have seen. Once the inventory, or I can say goods, reaches to the consignee's godown, till that we add all the expenses in the consignment stock. Okay, so next is a freight incurred amounted to 1,17,600, that we will add. Normal transit losses 2%. Enterprise actually received 19,500 kg and consumed 18,000 kg of the material. You are required to calculate the cost of material per kg and allocation of the material cost. Okay, so first of all, sir, how many kgs we have ordered? So we have ordered 20,000 kgs. Now there is a normal loss of 2%. So there is a normal loss of 2%. It means 400 kgs is nothing but the normal loss. So quantity to be received, or I can say expected to be received, is nothing but, sir, 19,600 kgs. But sir, actually how many kgs we have actually received? So sir, 19,500 kgs we have actually received. So can I say 100 kgs that we consider as abnormal loss? So 19,500 kgs actually received, out of which 18,000 kgs actually consumed. 18,000 kgs actually consumed. So can I say in inventory, or I can say if I'm talking about closing stock, then there are 1,500 kgs which are there in the closing stock. If you are able to understand this calculation with respect to only kgs, we will see in detail in terms of amount. Okay, let us see the calculation here. First of all, we will write the purchase price. It is 110 per unit, which includes this GST of 12. So 110 minus 12 rupees, we have to deduct this GST because they are saying purchase price includes GST of 12 per kg. So purchase price per kg, rupees 110 minus GST ITC available, GST also per kg, that is rupees 12. If we will deduct this, we will get rupees 98. Can I say this is nothing but the net purchase price per kg. Now we have to multiply by this quantity ordered. How many quantity? How many kgs? So 20,000 kgs. 20,000 kgs. So 20,000 into 98, that gives me 19,60,000. Then what we have to do, sir, we have to add freight amounting to 1,17,600. Add freight 1,17,600. That gives me 20,77,600. Okay, so we have got the total purchase value including the freight amount. Now we have to account for normal loss, abnormal loss both. How we are supposed to treat the normal loss and abnormal loss? So let us quickly discuss the difference between normal loss and abnormal loss. This is the similar question which is also there in JKC textbook. Okay, so normal loss and abnormal loss. So normal loss is nothing but due to inherent nature of the product only. It is nothing but the part and parcel of the product only. Whereas abnormal loss is nothing but due to carelessness, or I can say negligence of the businessman. Sir, normal loss will happen definitely. Sir, it is nothing but due to nature of the product only. Sir, we cannot insure normal loss because it is going to happen. That is sure. Sir, we can insure abnormal loss. Normal loss, since it is due to nature of the product only, it is nothing but the part and parcel of the product only. So let us pass this normal loss to the customer only, because we are anyway selling the product to the customer, and the normal loss is nothing but the part and parcel of the product only. If we are selling the product, let us pass this normal loss to the customer only. But abnormal loss we cannot pass to the customer. This abnormal loss will hit our P&L. Okay. So here I'll write rupees, kgs per kg. Cost of goods ordered, that is 20,77,600 and pure 20,000 kgs. that gives me 103.88 per kg. Now there is a normal loss. So I'll deduct normal loss. Boss, remember normal loss we have to pass to the customer only. So in case of amount column, we will write not applicable. And in terms of kgs, it is 2%. Then it is 400 kgs. So here it is 19,600. And this entire amount of 20,77,600, we have to recover from this remaining units. That is nothing but remaining kgs. That is 19,600 only. So 20,77,600 divided by 19,600. So it will give me 106 per kg. So that is nothing but cost of goods expected to be received. Okay, let us move ahead. What they are asking in the question, you are required to calculate the cost of material per kg. So we have calculated that, that is nothing but 106 per kg. If you can see in the solution, so calculation of a normal cost per kg, purchase price less input tax credit of GST which we are going to get, add freight, total cost of material this much, number of units normally received, that is nothing but 19,600, normal cost per kg is 106. Okay, let us move ahead. Now we have to deduct abnormal loss. Was this abnormal loss we will deduct? Obviously in the amount column also we have to reduce, that is nothing but in kgs it is 100, in terms of amount we will multiply by 106. So it is 10,600. Cost of goods or cost of material. If you want to write cost of material, you can write cost of goods actually received. So it is 20,67,000, 19,500, and this will remain same. If you have noticed something, then once you do the adjustment of normal loss, your cost per kg will inflate. If you can see, before adjustment of normal loss, it was 103.88. After adjustment of normal loss, it has become 106 because that normal loss we have to recover from the customer only. So per kg cost will inflate, which we are supposed to recover from the customer. Okay. Next, sir, consumed. And last is cost of closing inventory. Okay. Consume how many kgs? 18,000 kgs. So 1,500 kgs in stock. I will directly multiply this 1,500 into 106. So that is 1,59,000 is cost of closing inventory. So you can see in the solution, material consumed is 19,08,000, cost of inventory is 159, abnormal loss is 10,600. Material consumed is this column. That is 18,000 into 106, 19,08,000. Okay, with this question is over. Let us move to the next question. Next question is on AS10, property, plant and equipment. Star Limited purchased machinery for 6,80,000 inclusive of GST of 40,000. Input credit is available for the entire amount of GST. So if they are asking us to calculate the amount to be capitalized in machinery, then this 40,000 will be excluded. We are not supposed to take that. Let us see the requirement part quickly first. What they are saying. Calculate the value at which the plant should be capitalized in the books of Star Limited. So definitely, sir, here we have to calculate the capitalized value, or I can say the amount to be capitalized in plant and machinery. So this GST will be excluded. Input credit is available for the entire amount of GST paid. So this we have to deduct. Next, company incurred the following other expenses for installation. Okay, so sir, this is for installation. We have to add cost of preparation of the site for installation. Definitely this will be added in the cost of machinery. total labor charges they have given, and 200 out of the total 500 man hours worked were spent on the installation of the machinery. So total 500 man hours worked, out of which only 200 hours spent on the installation of the machinery. So don't you think so? Only the pro rata labor charges we have to add in the cost of machinery. So let me calculate. So this 56,000 is for 500 hours. Then for 200 hours, how much? Cross multiplication, 56,000 divided by 500 into 200. So it gives me 22,400 only we have to add. Okay, let us move ahead. Side by side we can just check the solution quickly. So this is purchase price, site preparation cost, labor charges 22,400. Let us move ahead. Spare parts and tools consumed in installation is 5,000. Definitely we will add. Total salary of the supervisor, they are saying time spent for installation was 25% of the total time work. So we have to consider only 25% of this 26,000. 26,000 into 25%, that gives me 6,500. Okay, so the 6,500 only we will add. Then total technical expense, 1/10 related to the installation. So sir, this 1/10 only we have to add, that is nothing but 3,400 we will add. So this 5,000, 6,400 and 3,400. Next, test run and experimental production expenses. Definitely sir, installation will be completed once the test run is over. They will check that whether the machine is properly working or not. So this cost of test run will also be added in the cost of machinery. Consultancy charges to architect for plant setup. So this is also installation expense we have to add. Depreciation, the asset used for installation. Let us say example, for installation some equipment is used or some tools or equipments used. So on that particular installation, if we have used certain equipments for installation, then on depreciation we have to add in the cost of machinery. So this 18, 11 and 12, all three amounts will be added. Last, they have deducted the GST credit receivable. So value to be capitalized is 7,39,500. There is one more item given. The machine was ready for use on 15th of January 2021, but was used from 1st of February 2021. First, asset was available for its intended use from 15th of January 2021. So in that particular case, sir, we have to stop capitalizing any of the amount incurred post 15th of January. Because once the asset comes in usable condition or it is available for its intended use, we have to stop capitalizing the expenses which we are incurring on that particular asset. Due to this delay, further expense of 8,900 were incurred. Calculate the value at which the plant should be capitalized. Suppose this 8,900 will not be capitalized because asset came into usable condition, or you can say it is available for its intended use from 15th of January. Even though we have not started using it, so that is nothing but our fault. We cannot add this 8,900 in the cost of machine. So this will not be added. So you can see the note which is given here, further expense of 8,900 from 15th of January 2021 to 1st of February 21 to be charged to P&L as a plant was ready for production on 15th of January. Okay, let us move to the next question. AS11. The effect of change in foreign exchange rates and AS16. So this is nothing but a combined question. I'm getting hint that this question is related to AS11 and AS16 both. It means this will be on para 4E of AS16, which talks about foreign borrowings, and where on account of foreign borrowing there will be foreign exchange fluctuation if the loan is there as on 31st March. Then what should be the treatment of that foreign exchange loss, or I can say foreign exchange difference, because the interest on the borrowings will be capitalized if the loan is taken for qualifying asset. But what about the exchange fluctuation? So para 4E of AS16 states some different treatment. So AS11 and AS16 both talks about this. Question number 18. Let us start. ABC Builders Limited had borrowed a sum of $15 lakhs at the beginning of the financial year 2021 for its residential project at London. Interbank offered rate LIBOR plus 4% and the LIBOR is 1%. So the interest rate on foreign borrowing is 5% because LIBOR rate is 1% plus 4%. So we have to consider interest at 5% on this foreign borrowing. Okay. The interest is payable at the end of the financial year. At the time of availing the loan, the exchange rate was 72 per US dollar and the rate as on 31st March 2021, that is nothing but year end, was 76 per US dollar. Now they are saying if the ABC Builders Limited borrowed the loan in Indian rupee equivalent, the pricing of the loan would have been 9.5%. This is nothing but the interest rate. If they would have borrowed the loan in India, then interest would be 9.5%. Compute borrowing cost and exchange difference for the year ending 31st March 2021 as per the applicable AS. Now, let us discuss para 4E of AS 16. Basically, AS 16 is borrowing cost. So, AS 16 para 4E talks about foreign borrowing. It says on foreign borrowing there is one component, that is nothing but the interest. The treatment of this interest will be as per AS 16 only. Treatment as per AS 16. What do you mean by as per AS 16? Means if this loan is taken for qualifying asset, then this interest will be capitalized in the asset, that is nothing but that qualifying asset. If it is not for qualifying asset, then interest will be charged to P&L. That is nothing but the simple treatment as per AS 16. That means if the loan is taken for qualifying asset, we have to capitalize this interest cost. If not, then we have to charge to P&L. Now, on this foreign borrowing, there is something that is called as exchange fluctuation. Now, what about this exchange fluctuation? So, there are multiple treatments for this exchange fluctuation. So, if I am talking about this exchange fluctuation, the first option is nothing but transfer this exchange fluctuation to FED account and that will go to P&L. That is a simple treatment which is given by AS 11. For that foreign borrowing should be there as on 31st March, because if you remember, after initial recognition, on every 31st March, we do subsequent recognition, balance sheet date recognition, or I can say re-recognition. So, we have to translate this foreign borrowing, because this foreign borrowing is nothing but the monetary amount. If you remember, what do you mean by monetary amount, non-monetary amount? So, monetary amount as per AS 11, that is nothing but the money held, assets and liabilities to be received or paid in fixed or determinable amount of money. So, sir, every monetary item will be translated at closing rate. So, sir, if we are translating this foreign borrowing, which is nothing but the monetary item, at year end, at a closing rate, then definitely there will be something which is called as exchange fluctuation, foreign exchange difference. So the first option is nothing but you can transfer this entire exchange fluctuation in FED account and then it will transfer to P&L as per AS 11. So as per AS 11, sir, that will go to P&L. Now another option. If loan taken is long-term foreign currency monetary item. The loan taken here, that this foreign borrowing is long-term foreign currency monetary item. With respect to depreciable fixed asset. Then any exchange fluctuation arising due to translation of this long-term foreign currency monetary item at year end, at closing rate, will be adjusted in the book value of the fixed asset and depreciation will be calculated on revised book value. But if this loan taken is long-term foreign currency monetary item with respect to other item. So what do you mean by other item? Let us say example, we have taken the working capital loan. Which is long-term foreign currency monetary item. So in that case, any gain or loss due to translation of this long-term foreign currency monetary item at year end on closing rate, or I can say at closing rate, will be accumulated in separate account called as FCMITD account, and it will be amortized over the tenure of the loan. So this long-term foreign currency monetary item, can I say this is nothing but para 46A of AS 11. So sir, there are multiple treatments, or I can say multiple options available for this exchange fluctuation. So sir, first is nothing but we can transfer this exchange fluctuation straight away to FD account. Then, so second option is available, that is nothing but para 46A. But para 46A can be used only if it is related to long-term foreign currency monetary item. If it is not a long-term foreign currency monetary item, then you cannot opt for this para 46A. So, if it is long-term foreign currency monetary item, and in that if it is related to depreciable fixed asset, then any exchange difference will be added or deducted in the cost or book value of the fixed asset, and the depreciation will be calculated on revised book value. But if this long-term foreign currency monetary item is with respect to other item, let us example working capital loan. So in that case, that exchange fluctuation due to translation of long-term foreign currency monetary item on balance sheet date at closing rate will be accumulated in separate account called as FCMITD account, and that will be amortized over the tenure of the loan on SLM basis. So sir, this is OR. Now there is one more option. Another option is nothing but para 4E of AS 16, which says this exchange fluctuation will be bifurcated into further two parts. First is equivalent interest component and balance FD account, which will go to P&L as per AS 11. And this equivalent interest component treatment as per AS 16, it means if this loan is taken for qualifying asset, then this equivalent interest will also be capitalized in the cost of qualifying asset. If it is not for qualifying asset, then this interest will also go to P&L. Hope you are able to first of all understand the three options available in case of foreign borrowing. These three options are for this exchange fluctuation and not for interest. Sir, treatment of interest will be as per AS 16 only. It means if this interest, if I am talking about, this interest will be either capitalized or it will be charged to P&L. For that, we need to check whether this foreign borrowing is for qualifying asset or not. If it is for qualifying asset, then the interest will be capitalized. If it is not for qualifying asset, then it will be charged to P&L. Okay. Sir, this exchange fluctuation, when we started with AS 11, so sir, this exchange fluctuation straight away we used to transfer to FD. So that is one option anyways available. But so then we saw para 46A, which says if this loan is taken, this foreign borrowing is long-term foreign currency monetary item, and in that also if it is related to depreciable fixed asset, then any gain or loss due to translation of long-term foreign currency monetary item on balance sheet date at closing date will be accumulated in, or I can say not accumulated, but it will be added, or I can say it will be adjusted, deducted in the cost of fixed asset only. But if it is with respect to other item, let us say working capital loan, then in that case it will be accumulated in a separate account called as FCMITD account, foreign currency monetary item translation difference account, and it will be amortized over the period of loan on SLM basis. Now, so the third option, second option is only applicable if it is related to long-term foreign currency monetary item. If it is a short term, then second option is not available. The last is nothing but para 4E of A16, which says this exchange fluctuation will be categorized, or I can say will be bifurcated into further two parts. How we are supposed to bifurcate, that we will see in that given question which is there in RTP. But how we are supposed to bifurcate, that we will see. But sir, here what we are supposed to do, that just I have written. This exchange fluctuation will be bifurcated into further two parts. First is nothing but the equivalent interest component, and second is nothing but the FD. So let us say example, just I am putting some numbers here. Let us say this exchange fluctuation is 50,000. out of which this equivalent interest component, let us say example 35,000 and this is 15,000. So sir, this 35,000 is nothing but treated as interest component and the treatment will be as per AS16 only. It means if this foreign borrowing is for qualifying asset, then capitalize this 35,000 in the cost of the qualifying asset. If it is not, then this will also go to P&L. Okay, and this 15,000 will definitely go to P&L only. Okay, let us see the question which is there in RTP. Here they are saying they have taken a foreign borrowing. This foreign borrowing is of how much? So sir, it is of 15 lakh US dollar. Okay, interest rate is 5% at the time of availing the loan, and we have availed the loan at the beginning of the financial year. Let us say on 1st of April 2020. So at that time the exchange rate was 72 per US dollar. Then at year end, that is as on 31st March 2021, the exchange rate is 76 per US dollar, and there is no information that they have paid the loan. So sir, definitely it is nothing but the long-term loan. Okay, sir, if it is a long-term loan, then para 46A of AS11 is also available. So listen carefully. If you are going for para 46A of AS11, then you cannot go for para 4E of AS16. So you have to select any one, because the treatment as per para 46A and treatment as per para 4E of AS16 is totally different. So either you select para 46A of AS11 or you go for para 4E of AS16. Okay. Now here we will go for para 4E because they have given certain hint. Because here they are not saying anything that organization is following para 46A of AS11 or para 4E of AS16. They have not given any information. But if you can see, they have given some hint. What is the hint? Here, if ABC Builders Limited borrowed the loan in the Indian rupee equivalent, the pricing of the loan would have been 9.5%. They are saying if the loan would have been borrowed in India, then the interest would be how much? 9.5%. So this is nothing but the hint where we can conclude that we have to use para 4E of AS16. How we are supposed to use? Let us see. Sir, first of all, we have to calculate the interest on the foreign borrowing. That is nothing but this part. Interest on the foreign borrowing. Let us calculate the sir interest on foreign borrowing. Sir, foreign borrowing is 15 lakh US dollar. 15 lakhs. Okay. So what is the interest rate? So LIBOR plus 4%, that is nothing but 5%. And definitely this interest you are going to pay at the end of the year. So sir, year end exchange rate is 76. So you have to multiply by 76. So we will calculate this interest. 15 lakhs into 5% into 76. So sir, that comes to 57 lakhs rupees. Interest for the period 2021 is 57 lakhs. Okay. So we have calculated 57 lakhs of interest on the foreign borrowing. The treatment of this interest will be purely as per AS16. If the loan is for qualifying asset, then we will capitalize. If it is not, then we will charge to P&L. So sir, that is nothing but 57 lakhs, that is over. Now let us calculate the exchange of fluctuation. For exchange fluctuation, we have to see this loan was initially recognized in a books of accounts at 72. That is nothing but the initial recognition. Now the subsequent recognition will happen at 76. So the loan amount will increase by rupees 4 per dollar into sir 15 lakh dollars. Okay. So here if I want to write $15 lakhs into rupees 4. So that is nothing but I'm writing here on this side, or I can say just let me write this calculation here only. $15 lakhs into rupees 4. Purposefully I'm writing all the calculation in this chart only, so you will be able to recognize more easily. So 15 lakhs into 4, that is nothing but 60 lakhs rupees. Now we have to bifurcate this 60 lakhs into two parts: equivalent interest component and FD. Hope you are able to understand. I'm repeating once again. We have to bifurcate this exchange fluctuation into two parts. Let us forget the other two options. We will not get into that. I will just remove those other options. Just wait a second. So these options are not available. So exchange fluctuation, we have to to the two bifurcation into equivalent interest component and the FD. So 60 lakhs will be bifurcated into two parts. Now let us move ahead. Now they are saying if the loan would have been borrowed in India, then interest would be how much? 9.5%. Now if we would have borrowed the loan in India, then obviously we would have borrowed on 1st of April 2020 only. That is at the beginning of the financial year. And that time the exchange rate was 72. So let us calculate the loan amount which we would have borrowed in India. So sir, that is nothing but 15 lakhs dollar into 72. It comes to 1080 lakhs. So let me calculate interest on Indian loan. Interest on Indian loan. It means if the loan would have been borrowed in India, then interest would be how much? So sir, dollar 15 lakhs into exchange rate at the time of availing the loan, it was rupees 72 per dollar into, sir, interest on the Indian loan is 9.5%. So it gives me 102.6 lakhs, or I can say 102 lakh 60,000. Okay. 1 crore 2 lakh 60,000. So now, sir, if we would have borrowed the loan in India, then interest would be how much? Sir, interest would be 102.6 lakhs. But since we have borrowed the loan from the foreign country, the interest is how much? Sir, 57 lakhs. If we would have borrowed the loan in India, then we would have capitalized 102.6 lakhs in the qualifying asset. But since we have taken the loan from the foreign country, interest is only 57 lakhs. So actual interest is 57 lakhs. So one will say that we have to capitalize only 57 lakhs. But standard says, if we would have borrowed the loan in India, then the interest would be 102.6 lakhs. Then standard is allowing us to capitalize. Standard is allowing us to capitalize the interest to the extent interest on Indian loan. So, sir, we can capitalize to the extent of 102.6 lakhs. So, now what we are supposed to do? This exchange fluctuation, you can see, this exchange fluctuation of 60 lakhs, out of which some component we can treat as interest, or I can say equivalent interest component. How to calculate? Sir, if we would have borrowed the loan in India, then we would have capitalized 102.6 lakhs. But, sir, since we have taken the loan from the foreign country, the actual interest, see, basically, can I say this is nothing but the notional interest? This is notional because this is not the actual. Actual is this one. This is nothing but the actual interest. So, since the actual interest is 57 lakhs, 57 lakhs. So, the difference is 45.6 lakhs. Standard says you can capitalize this as an interest out of exchange fluctuation. So, sir, 45.6 lakhs we can capitalize as an interest, or I can say we can consider as an interest out of the 60 lakhs of exchange fluctuation. Then how much amount will go to FD, or I can say PNL? Then, sir, it is nothing but the 60 lakhs minus 45.6 lakhs. So the difference is 14.4 lakh will be treated as FD. It will transfer to PN. Let us see the answer. See, the interest for the period is 57 lakhs. That is nothing but the actual interest. Increase in the liability towards the principal amount. That is nothing but the subsequent recognition. So, sir, that is nothing but the 60 lakhs exchange fluctuation. Exchange fluctuation. This exchange fluctuation we have to bifurcate into two parts: equivalent interest component and FD. Now, interest that would have resulted if the loan was taken in the Indian currency. So that is 102.6 lakhs. So difference between interest on local currency borrowing and the foreign currency borrowing, that is nothing but a 45.6 lakhs. So out of this exchange fluctuation of 60 lakhs, 45.6 lakhs we can treat as equivalent interest component, and the balance, so balance is nothing but the 14.4 lakhs will be treated as exchange fluctuation. The treatment will be as per AS 11. So you can see here. Therefore, out of 60 lakhs increase in the liability towards principal amount, only 45.6 lakhs would be considered as a borrowing cost. Thus, the total borrowing cost would be 102.6 lakhs, being the aggregate of interest of 57 lakhs on the foreign currency plus the exchange difference to the extent of difference between interest on the local currency and the interest on the foreign currency borrowing. Hence, 102.6 lakhs would be considered as the borrowing cost to be accounted for as per AS 16 borrowing cost, and the remaining 14.4 lakhs would be considered as the exchange difference to be accounted for as per AS 11, the effect of changes in foreign exchange rate. So, this is a good question. We are done with this problem. Let us move ahead. AS 12, accounting for government grant. Hygiene Limited had received a grant of rupees 50 lakhs in 2012 from the state government towards installation of pollution control machinery on fulfillment of certain conditions. So we have received the grant. This is nothing but the monetary grant. In that, for purchase of fixed asset, in that depreciable fixed asset. The company, however, failed to comply with the said conditions and consequently was required to refund the said amount in 2022. Okay, after 10 years, they are supposed to refund this amount. Company debited the said amount to its machinery account in 2022 on the payment of the same. It also reworked the depreciation for the said machinery from the date of its purchase. So after refund, we have to calculate the revised depreciation on the revised book value. Are we supposed to calculate, or I can say, if I want to say specifically, are we supposed to recalculate the depreciation which we have charged in last 10 years? The answer is no. So the effect should be given prospectively and not retrospectively. So they have calculated the depreciation for the said machinery from the date of purchase and passed necessary adjusting entries in the year 2022 to incorporate the retrospective impact of the same. State whether the treatment done by the company is correct or not. Absolutely no. Let us see. As per the facts of the case, Hygiene Limited had received a grant of 50 lakhs in 2012 from the state government towards installation of pollution control machinery on fulfillment of certain conditions. However, the amount of grant has to be refunded since it failed to comply with the prescribed condition. In such case, AS 12 states that amount refundable in respect of a government grant related to a specific fixed asset is recorded by increasing the book value of the asset or by reducing the capital reserve or deferred income balance as appropriate by the amount refundable. So see, they are saying increasing the book value of the asset. It means if they have adopted capital approach, reducing the capital reserve if it is treated as promoter's contribution, or the deferred income, revenue approach, etc. The standard further makes it clear that in the first alternative, where the book value of the asset is increased, depreciation on the revised book value should be provided prospectively, the residual value of the life of the asset. Accordingly, the accounting treatment given by the Hygiene of increasing the value of the plant and machinery is quite proper. However, the accounting treatment in respect of depreciation given by the company of the adjustment of depreciation with retrospective effect is improper and constitute violation of AS 12. Next, let us move ahead. AS 13, accounting for investment. Very easy question. Similar question is also there in JKC textbook. Gotham Limited invested in shares of another company with the intention to hold the shares for a short term period. Because they have specifically mentioned here short term period. So if it is for a short term period, then it should be considered as short term investment. Short term investment will be valued at lower of cost or market value. So long term investment will be always valued at cost unless and until there is a permanent reduction. Okay. 30th November they have invested. They have specifically mentioned it is a short term investment. So no need to decide whether it is a short term or a long term investment. They have specifically mentioned. Cost is 4,25,000. It also earlier purchased gold of 8 lakhs and silver of 3,50,000 on 31st March 2019. Long back. Market value as on 31st March 2022 of the above investments are as follows: shares, gold and silver. You are required to explain how will the above investment be shown individually and in total in the books of account of Gotham Limited for the year ending 31st March 2022 as per the provision of AS 11. Now first of all, here if I am talking about shares is short term, gold and silver is nothing but long term. And gold and silver, generally it will be treated as long term only, because no one will invest in gold or silver, I can say, in short term period. Okay. So, sir, shares is short term, it should be valued at lower of cost or market value. Sir, cost is how much? Sir, cost is 4,25,000. Market value is 3,50,000. So, sir, it will be valued at 3,50,000. That is nothing but the market value. And in case of gold and silver, it will be valued at cost only. That is 8 lakh and 3,50,000. So the value will be shares valued at 3,50,000, gold 8 lakhs, and silver 3,50,000. Let us see the solution. As per AS 13, for investment in shares, if the investment is purchased with an intention to hold for a short term period less than 1 year, then it will be classified as current investment and to be carried at lower of cost and fair value. In case lower of cost and the market value as on 31st March 2022 is 3,50,000. Gold and silver are generally purchased with an intention to hold it for a longer period, more than 1 year, until and unless given otherwise. Hence, the investment in gold and silver should be continued to be shown at cost only. That is nothing but 8 lakh and 3,50,000 respectively, though their market values have been increased. Thus, the shares gold and silver 3,50,000, 8 lakh and 3,50,000 respectively, and the total investment will be valued at 15 lakhs for the year ending 31st March 2022 as per AS 13. Let us move ahead. Let us see the last question. That is nothing but AS 16, borrowing cost. Expert Limited issued 12% secured debentures of rupees 100 lakhs on 1st of June 2021. Okay. Money raised from debentures to be utilized as under: construction of a factory building, they have utilized 40 lakhs, working capital 30, this 15, year 2, year 13, so total 100 lakhs. Definitely not on the very first day they have utilized this entire amount of 100 lakhs altogether. They have utilized over the period of time, but 100 lakhs entirely now utilized. Because in construction of a factory building, if I can say, initially they would have invested 10 lakhs, then they added more 10 lakhs, then they added more 10 lakhs, then they added more 10 lakhs, and this is how it came to 40 lakhs. Okay. Now, AS 16 talks about borrowing cost, where we have to talk about capitalization of the borrowing cost. We can capitalize the borrowing cost, that is nothing but the interest and other borrowing costs, only and only if the borrowing is taken for the qualifying asset. So first of all, let us check out of these 5 assets, which one is, or I can say out of these 5 purposes, which one is for qualifying asset. First is construction of a factory building. Yes sir, this is nothing but the qualifying asset. As you all are aware, what do you mean by qualifying asset? So qualifying asset is an asset which necessarily takes substantial period of time to get ready for its intended use or a sale. Okay, so sir, this construction of a factory building is qualifying asset. Working capital, sir, not a qualifying asset. Machinery we have just purchased, not a qualifying asset. Purchase of furniture, not a qualifying asset. Purchase of truck, not a qualifying asset. Okay, so sir, your qualifying asset is only construction of the factory building. In that only we have to capitalize the borrowing cost. First of all, if you can see here, there is a debenture of 100 lakhs at 12%. So first of all, let me calculate the interest. So I am saying it is 100 lakhs into 12%. And so 1st of June, we have issued on 1st of June. So we have to calculate only for 10 months. So 12, okay. So it comes to just 10 lakhs. Okay. Wait, let us read the additional information first, and then we will come to the conclusion that how much borrowing cost we have to capitalize. Interest on debentures for the financial year 2021 was paid by the company. Okay. During the year, the company invested idle funds of 5 lakhs out of the money raised from the debentures. So they have invested this idle fund in bank's fixed deposit and on interest of 50,000. Okay. If you remember, I said on the very first day, the moment we issue the debentures, we have not invested entire 40 lakhs in the factory building on the very first day. That is nothing but on 1st of June. Initially, we invested 10 lakhs, then we added more 10 lakhs, then we added more 10 lakhs. So till that time, sir, funds of rupees 5 lakhs were idle. So they have invested in bank FD and they have earned the interest of 50,000. So that 50,000 interest we have to reduce from the total borrowing cost, and the net borrowing cost will only be capitalized, because in case of specific borrowing, so if there is an idle fund and which we have invested and we have earned some income, that income will be adjusted in the total borrowing cost and the net borrowing cost will be capitalized. So if you can see here, the interest which we have calculated here on the left hand side is 10 lakhs minus this income earned, that is nothing but 50,000. So borrowing cost available for capitalization is 9.5 lakh. Are you able to understand this? Okay, let us move ahead. In March 2022, construction of a factory building was not completed. It is expected that it will take another 6 months. So, sir, 10 months plus 6 months, that is nothing but 16 months. Anyways, it is more than 12 months. So, definitely, sir, it is to be considered a substantial period. Okay. In March 2022, machinery was installed and ready for its intended use. Since we have just purchased and it is available for its intended use, so sir, this is not a qualifying asset. Furniture was put to use at the end of March. Okay, that doesn't mean that we will be treating that furniture as a qualifying asset. It is not a qualifying asset. Truck is going to be received in April, not a qualifying asset. You are required to show the treatment of interest as per AS 16 in respect of borrowing costs for the year ended 31st March 2022 in the books of Expert Limited. Okay, let us see. Sir, entire amount of 100 lakhs which we have raised from issue of debentures is to be capitalized if it is only used for qualifying asset. So sir, in qualifying asset they have used only 40 lakhs. So sir, can I say proportionate borrowing cost will be capitalized? So out of 100 lakhs, 40 is only utilized for the factory building. Then only borrowing cost on that 40 we have to capitalize. It means this 9.5 lakh is for entire 100 lakhs. Then for 40 lakhs, how much? So, sir, 9.5 into 40 divided by 100. So, that gives me 3.8 lakh we have to capitalize. Rest, everything will go to P&L. So, you can see the solution here. 3.8 lakh they have capitalized. Interest to be capitalized and interest to be charged to profit and loss account. That is nothing but the rest entire will go to P&L. Now, just see here. According to A16 borrowing cost, a qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use. As per the standard borrowing costs that are directly attributable to the acquisition, construction or a production of a qualifying asset should be capitalized as part of the cost of that asset. The amount of borrowing costs eligible for capitalization should be determined in accordance with this standard. Other borrowing costs should be recognized as an expense in the period in which they are incurred. Now, this is important. It also states that to the extent that funds are borrowed specifically for the purpose of obtaining a qualifying asset, the amount of borrowing cost eligible for capitalization on that asset should be determined as the actual borrowing cost incurred on that borrowing during the period less any income on the temporary investment of those borrowings. So they have calculated here that interest is 10 lakhs minus 50,000 that income we have earned from that FD. So sir, the eligible borrowing cost is 9 lakh 50 only. So with this, RTP of paper 1 accounts accounting standard is over. Thank you so much. All the very best. God bless.